Welcome to Behind the Advice, the podcast for Australians living abroad who want to maximise their financial situation. I'm your host, Mitchell Kelsey, a financial advisor at Runway Wealth Management, and in each episode, I'll be sitting down with other experts and professionals to get their insights, stories, and expertise on key concepts for Australian expats, as well as providing my own perspective. With this being a financial podcast, there is a disclaimer, so any information that you hear in today's episode is general information only. It is not personal advice, so it does not take into account your personal situation, goals, or objectives. If you do need personal advice, feel free to reach out to us at Runway Wealth Management for personal financial advice. Welcome back to the Behind the Advice podcast. The episode today is navigating your Australian taxes as an Australian expat. Now, this is a very complicated area for Australian expats. I think when you're navigating your taxes as an Australian expat, not only do you have to navigate your Australian taxes, but also navigating your host country tax returns as well. So in today's episode, we're mostly just going to focus on managing and making the most of your Australian tax situation. And in today's episode, I'm really pleased to be joined by Nathan Cosley from Costical Taxes, who's a tax advisor. How are you, Nathan? Great to have you on the podcast today.
Great to be here. Thanks, Mitchell.
Tell us a little bit about your background as a tax advisor. I know you started out being a tax accountant, so tell us a little bit about your experience working in tax.
Yeah, so I started out at EY, or Ernst & Young it was back then, in Melbourne. Great opportunity, a great place to learn a lot from a lot of senior people there. And then, like most Aussies, when you're young, decided to go travelling overseas for an extended period of time. And also, like a lot of Aussies, after 6 months of travelling, when you're young, you run out of money, and the easiest place to get a job, and where I was at the time, was the UK. So made the most of that. 6 months stint in the UK turned into 15 plus years in the UK. I now spend my time between Australia and the UK. But being in the UK for such a long time, had a great opportunity to learn a lot about the local tax system over there, and also how to navigate the Australian system whilst being abroad for so long. So it was always on my mind as something to be across in terms of when I eventually returned to Australia permanently. So being able to sort of manage the exit from the UK and the return to Australia was something top of mind, and was basically the reason why I got into helping out expats by providing tax planning advice to them.
Yeah, really interesting. So, I mean, absolutely, you've had that first-hand experience being an Australian expat, navigating your taxes in Australia and the UK, and I'm sure that's been invaluable in being able to give advice to clients that are residing overseas.
Yeah, absolutely. So it's something I'm keenly interested in personally, and then obviously being able to provide that advice and lessons of what I've learned to other people in similar situations has been invaluable.
Yeah, definitely. I'm sure. Now, we mentioned, we kind of introed you as a tax advisor. Do you want to maybe just give the listeners a quick just highlighting the difference between a tax advisor and a tax accountant, because they are slightly different.
Thanks, Mitchell. Yeah, that's a really, really good question. So I guess an accountant is a bit of an umbrella term for someone or a firm that handles lots of things, which could include preparation of tax returns. Often when people engage an accountant, they think that they're also getting tax advice, but actually they're just engaging the accountant to prepare their historical tax returns. So if you really want advice on how, prospective advice on how to better plan your tax affairs and, hopefully save tax in the future, then really recommend you getting specific tax advice. And it can be super valuable in terms of getting your affairs structured in a way that, you pay the right amount of tax still, but you don't unnecessarily pay extra.
Yeah, absolutely. So it's a little bit more on the strategic advice side of things, less kind of transactional. You're doing more than just kind of helping someone file their tax return, whether that be for, at an individual level or a company or a trust level, you're doing a little bit more than that.
Absolutely, yeah. Much more forward-looking. So looking into the future, getting things set up in such a way so that by the time either your tax advisor or an accountant comes to do your tax return, then everything's already been optimized and there's no further work to do.
Yeah, that's a really good summary there. The topic I wanted to get into firstly, or the subject, is tax residency. We're going to keep it a little bit more simple and just talk about individual tax residency, not company or tax residency for companies. And this is probably the most complicated area, and where I spend, I do have a lot of discussions with prospects and clients about. As a financial advisor, clients are just unsure of what their tax residency status is in Australia. So they're not sure if they're a resident for tax purposes or a non-resident for tax purposes. So I'll ask you, Nathan, as the expert, how does an Australian expat determine their Australian tax residency status?
It's a very, very good question. I guess just to start with a little bit of context. So the Australian tax residency tests were written in 1936 and they haven't been updated since. So as you can imagine, they're not super helpful, super useful. The legislation, that is, in terms of, our globally, internationally mobile, environment that we live in today. So as a result of that, there's been a lot of topics, a lot of
there's been a lot of calls to modernize it, right? Like by government, by related parties, interested parties.
Absolutely, yeah, absolutely. Unfortunately, nothing has changed, so we're still dealing with the 1936 rules. But the ATO have provided some useful guidance in terms of what it means to be a resident or not within one of their taxation rulings, 2023/1, which I guess captures a lot of the case law on this particular topic. So yeah, this has been litigated by those with deep pockets and lots to win or lots to lose. So it's a super important topic in the context of being an expat.
Yeah, and it's the legislation is written to capture varying taxpayer situations, right? That's why it's not necessarily a one size fits all piece of legislation. Maybe we can we'll just touch on the 4 tests to determine tax residency status in Australia. Did you want to just give a really high level overview of the 4 tests that we have in Australia?
Yeah, absolutely. I'll start with the easy ones. So if you generally spend more than 183 days in Australia, you'll be a tax resident of Australia. Also, if you're a member of one of the Commonwealth Government superannuation schemes, you also retain your residency if you leave Australia as well. That's a very bespoke piece, so you need to be a member of a very specific superannuation scheme, so it doesn't apply to many people. Outside of those 2 tests, the next test is called the domicile test. So this is where if you have an Australian domicile, you'll be an Australian tax resident unless you can evidence that you've got a permanent place of abode outside of Australia. So that's very important. Evidencing that requires you to have a new place outside of Australia, but also importantly, in a lot of cases, requires you to give up your Australian residency. That could mean renting it out if it's a property that you own. That's fine. To not be caught by that particular limb of that test. But yeah, that's the domicile test, and then the primary test is called the resides test. So this is the one where the legislation says you're a tax resident in Australia if you reside in Australia. So there's broadly 6 principles that we look at in terms of what it means to reside in Australia, and therefore whether you're a tax resident or not. Those principles, depending on the answers, if 4 of those principles point towards you being resident, then you'll be resident overall. If 4 point towards you being non-resident, then you'll be non-resident. So it's on the balance of probabilities, and you just need to have more than 50% of the factors pointing in a particular direction. So some of those factors include what your intention was when you left Australia. So was it to be away only for a short period of time, or to be away for a long period of time? 2 years is a rough rule of thumb that's used in that context. So anything less than that is seen as a temporary or transitory absence from Australia, and therefore you're more likely to retain your tax residency status. The second point is around your physical presence in Australia. So obviously the more number of days you spend physically in Australia, the more likely or the stronger that is going to count towards you retaining your tax residency status. The third element is your business and employment ties. So if you were to continue to work for an Australian employer whilst you're travelling around overseas, that would count more towards you being resident than not. Fourth factor is around your family. So if you've gone overseas but your spouse has stayed in Australia, then again that'll count more towards you retaining your residency status. The fifth factor is around your sort of social and living arrangements. So have you established a new home in your new country or not, or have you retained your home in Australia? And then the last factor is around where are your assets located. So are most of your assets still in Australia, or most of your assets in the new geography that you're in?
Very succinctly summarized, mate. That was impressive. Just rattling off all those factors, and just for context as well, like all of those factors are just for the resides test. So this is just the one test. This is the primary test that Nathan is referring to there. And why don't we stay on the resides test for the moment? And for Australian expats, I think ultimately most want to be a non-resident for tax purposes, right? Because as a non-resident, you're only subject to tax on your Australian sourced income. If you've got an overseas salary, you obviously don't want that subject to taxation in Australia. So if we stay on the resides test, what would you say of those factors that you just mentioned there? What factors really carry the most weight? You would see if an individual wants to be a non-resident.
Good question. I need to preface that by saying that every case is unique and different. So unfortunately, there's no blanket guidance. But I guess a couple of those particular factors that stand out. One is around your intention. So and along with that, it's not just what were you thinking at the time, but it's what actions have you undertaken to support that intention. So if you've left Australia but you don't have a work visa for any particular country overseas, then that's not very strong evidence of you being able to cease your Australian tax residency status, for example. So, but if you do, on the other hand, if you did move to another country and you had a 3-year working visa for that particular country and had a job in that particular country, then that's going to be quite strong evidence towards you ceasing your Australian tax residency status. I think the other one that's important is your sort of connection to the new geography that you're in. So have you established new social connections? Have you either bought a new property in that country or rented a property in that country? How embedded are you in the lifestyle of that new country, or are you just there sort of as a long-term tourist? I think they're two of the factors I'd draw out.
Yeah, and there's been there's been rulings in the courts where an Australian expat has resided overseas for many years, and they still remain. It was ruled that they still remain a resident for tax purposes because the nature of their stay overseas was transitory in nature, right? There was no degree of permanence. Like they didn't have a rental lease. They didn't have their immediate family with them. So those are some of the cases that we see come out in the courts where the ATO rules that an Australian expat is still a resident for tax purposes. And it's worthwhile noting, we've just given a high level of the 4 tax residency tests. It's worth noting that you need only meet one of these tests, and essentially to be a non-resident, you just need to not meet any of those 4 tests. So that's kind of how the rules work. And as with as with most tax matters that you handle as a taxpayer in Australia, it's a self-assessment. It's a self-assessment model, right? So you make the declaration that you are a non-resident, and then you obviously want to have the evidence to support that based on your current situation, and then it's a case where the ATO can argue against that should they wish. So maybe just do you want to just give a high level in terms of how an Australian expat makes it known that they're a non-resident for tax purposes? So what do they have to do?
Yeah, so as you mentioned, it's a self-assessment system in Australia. So that notification of becoming non-resident is completed as part of the tax return submission for the particular year after you depart Australia or after you become non-resident for Australian tax purposes. So that's the key point when the ATO become notified. I mean, there is an opportunity that if you have a bit of a borderline case and or if you want a sort of guaranteed position before you submit your tax return, you are able to, with the advice and support of a tax advisor, draft what's called a private binding ruling to submit to the ATO. So this is an outline to say, this is a particular tax law, this is my facts, this is how I think my facts apply to the tax law. For example, this is why I believe I'm non-resident for Australian tax purposes. And then that's submitted to the ATO, and then the ATO review that and they say, yes, I agree that you're non-resident, or I don't agree, can you provide further information or whatnot. So whatever that decision is, it's guaranteed. So it's binding on both you as the taxpayer and the ATO. So neither party can change their mind in the future, as long as the facts that you've outlined in the case do not materially change in the future. So for those that have a more borderline situation and want some certainty, then the private binding ruling is an option to explore.
Yeah, absolutely. And I would argue, for first-time Australian expats, getting some advice from a tax advisor or a tax accountant to determine your tax residency status is critical. Don't try and work it out yourself based on the legislation, just because it is very subjective and it's complicated. It's far from straightforward. We might change not necessarily change gears, but stay on the topic of tax residency, but just touch on the proposed tax residency rules. So this has arguably created a lot of confusion amongst Australian expats. Now, just for some background and some history, there was a report that was published by the Board of Taxation back in 2019, and in the 2019 report, there were a series of recommendations from the Board of Taxation, and I'd say one of the main proposals that got a lot of attention from expat communities, Australian expats, is this idea of a 45-day test, where if an Australian expat came back to Australia, they spent more than 45 days in Australia, and they had two or more factors kind of connecting them to Australia, they would be a resident for tax purposes. And there was further consultation around 45 days. A lot of groups lobbied for those 45 days to be updated to 90 days. Now, all of this kind of speculation went on that the 45-day test is now legislation, which certainly wasn't the case. And even up to this day, these rules are not law. This is not current tax legislation. Currently, the rules set out in the 1936 Income Tax Assessment Act, so the four tests that we just touched on, those still remain the current legislation for determining tax residency status. Nathan, I'm not sure if you have any comments on or thoughts on these proposed tax residency changes that were announced in 2019.
Two items, I guess. One, just to reiterate that they are just proposals and they're not current law. So just to be super clear on that point. And then secondly, I think the general theme of the proposal was to capture more people within the Australian tax residency net. So make it harder to lose your Australian tax residency status, I think was the overall theme of those proposals. But again, just to come back to the first point, they are not law. So, I think we just need to treat it as such for now.
Yeah, absolutely. Absolutely. Let's change gears now and touch on, what sorts of income are taxable for Australian expats who are non-residents for tax purposes. What would you say are some of the most common examples of income that is still taxable with the ATO for Australian expats?
Yeah, so maybe even if we step back one step further and just talk about, I guess, tax from an international context. And I guess there's two criteria that are important as an Australian expat. One is your residency status in Australia, which we've discussed. And the second point is the country of source of a particular income type that you receive. So, in a nutshell, international tax really is dependent on those two concepts of residency status and source. So as a non-resident for Australian tax purposes, you remain taxable in Australia on your Australian sourced income. So very clearly, income from an investment property based in Australia has an Australian source, so remains taxable in Australia. Any bank interest that you earn from an Australian bank account has an Australian source and therefore taxable in Australia. Any dividends that you earn from Australian shares have an Australian source, although depending on whether the dividends are what we call franked or unfranked, the tax consequences vary. So yeah, they're three of the sort of common examples of Australian sourced income that remains taxable in Australia once you become non-resident.
Yeah, really good overview. And that income is subject to different tax rates than if you were a resident for tax purposes, correct? Do you want to just give a high level in terms of the foreign resident tax rates and what they look like?
Yeah, so importantly, as a foreign or non-resident for Australian tax purposes, note we just use the concept of foreign and non-resident interchangeably. They mean the same thing. Unlike an Australian tax resident, a non-resident does not get a tax-free threshold. So the $18,200 tax-free threshold that Australian residents enjoy goes away. And so as a non-resident, you're taxable in Australia on your very first dollar of income, taxable income that you earn. So that's an important point, especially for those with property that's positively geared, for example. So that will be taxed at 30% on the very first dollar of taxable income that's earned. Once you get over $135,000, then the tax rate increases to 37%, and then over $190,000 it increases to 45%. So most individuals that are non-resident that have taxable income between $0 and $135,000 will be taxed at 30% on that. There is an exception for a couple of types of income. So bank interest, whilst you're a non-resident, the maximum tax rate that the ATO can impose is 10%. So that's an important point. And then in terms of dividends, an unfranked dividend is taxable at 30%, albeit that may be altered by a double tax agreement with the host country that you're living in or tax resident of at the time. And then a fully franked dividend, actually, there is no further personal tax to pay in Australia on that. So, that can be quite attractive from a tax perspective in terms of from an investment and generating income that's not subject to Australian tax in the form of fully franked dividends.
Absolutely. And it's clean from a tax return perspective as well, because I understand, the bank interest is automatically withheld by your financial institution, so long as they know that you are a non-resident for tax purposes. And if you've got some Australian shares that are paying some dividends, and the investment account that you've got those investments held through, if they know that you're a non-resident, they can automatically withhold the withholding tax. And if those are kind of your only main source of Australian income, Australian sourced income, your tax return is very simple. It's not as if you're having to report those kinds of income, because it's already been the relevant final tax has already been withheld.
And just on that point, just to be clear, if the only income you've got is from bank interest and fully franked dividends, and the right amount of withholding tax has already been held by the relevant institutions or share registry, then there's actually no requirement to do an Australian tax return. So it can help ease your compliance burdens as well too. Just back on the dividends, when we talk about unfranked dividends, there's actually a couple of subcategories within there as well. So generally an unfranked dividend will be taxed at 30% in Australia, or a lower tax rate depending on relevant double tax agreement with your host country. There is an exception. So if you do receive what's called conduit foreign income, which is where the Australian company has generated that income outside of Australia and effectively is paying to you via a dividend, and you're a non-resident, then that's actually completely free from Australian tax as well. So yeah, just wanted to flag that.
Yeah, really good point. It's particularly important for Australian expats that have got an Australian, a managed fund in Australia or an ETF, and all of those investments all of those companies held in that particular investment are overseas. So any income that you're receiving from those companies is highly likely to be conduit foreign income, and yeah, as you said, tax free. You mentioned a good point before on tax treaties or double taxation agreements. Do you want to just give a very quick summary in terms of what these tax treaties are and how they work? Absolutely.
So a double tax agreement can be your ultimate friend in certain circumstances. So the way a double tax agreement works is it prescribes how certain categories of income, how the taxing rights over those categories of income or capital gains are allocated between countries. So, I mean, if we just take an example, let's say we're talking about an Aussie expat that's become non-resident for Australian domestic tax law purposes, but is now living in the UK and is a UK tax resident, then the double tax agreement will dictate whether the UK or Australia or neither have the right to impose tax on certain forms of categories of income, whether it's employment income, interest income, dividend income, capital gains, etc., etc. So in that way, a double tax agreement can be helpful. The other point on double tax agreements is that if you are still an Australian tax resident under Australian domestic tax law, even though you've physically departed Australia, and you've become a tax resident in your local country where you're now living, then you're tax resident in two countries at the same time. So what happens? So helpfully within a double tax agreement, usually it's contained within Article 4 of the standard double tax agreements, that will then allocate which country you'll be treated as sole tax resident of for the purposes of that double tax agreement. So a really good example is that if we just continue the previous example of a UK tax resident, and let's assume that they're still an Australian tax resident under Australian domestic tax law, if they're working with a UK employer, then as an Australian tax resident, Australia can tax their worldwide income, so that ordinarily would include their UK employment income. However, the double tax agreement overrides Australia's domestic tax law if the individual is sole tax resident of the UK for the purposes of the double tax agreement and performs all of their employment duties from the UK, such that the double tax agreement says only the UK can tax that income. So it's really important point, especially given the personal tax rates in Australia are relatively high on a global scale. So often if that double tax agreement didn't exist, there would be an amount of top-up tax that would be paid to the ATO in Australia. But by virtue of double tax agreements, that can be alleviated. So it's a really important point. I guess I just want to flag that it's not a topic that's generally well understood with accountants and tax advisors that look at just domestic tax issues in Australia. So I'd really, if you are in that situation, I'd really implore you to work with someone that understands how a double tax agreement works, preferably the double tax agreement with the particular country that you're now living in.
Yeah, absolutely. Really good point there. I think, there's foreign income tax credits that you could be, missing out on if you're not taking full advantage of those double tax agreements or tax treaties. And yeah, unfortunately, Australia doesn't have a tax treaty with all countries. So, a good starting point is just understanding whether or not the country in which you're residing in as an Australian expat has a tax treaty, and that can be relatively easy found out online. Let's chat about property. I think property from a capital gains standpoint, Australian expats love property. A lot of Australian expats still hold property back home in Australia. Let's maybe just have a chat about the capital gains tax considerations for Australian expats that might have property back home. The two, importantly, I wanted to chat to you about are the main residence exemption and then the 50% CGT discount. So we'll start with the main residence exemption, and this capital gains tax concession was abolished for Australian expats back in 2020, and essentially it removes the ability for an Australian expat when selling a property as a non-resident, or selling a property that was previously their main residence as a non-resident for tax purposes. It prevents them from being afforded this full capital gains concession on the sale of that property. There are some extenuating circumstances where it may still apply, but in most cases, the main residence exemption is not available to non-residents, non-resident Australian expats. And that's just a really important consideration to keep in mind if you are an Australian expat considering selling a property that was previously your main residence, because the capital gains tax could be catastrophic. Like we're talking. Yeah.
Well, just on that point, I mean, I spoke to a couple not that long ago who had recently left Australia and become non-resident for Australian tax purposes, and for various reasons needed to sell their former Australian main residence property. Now, they'd lived in that property for 29 years of the 31 years that they'd owned it. So if they were an Australian tax resident, assuming during the 2 years that they didn't live there, assuming they didn't have another main residence property anywhere in the world, they would have had a full capital gains tax exemption for the whole capital gain that accrued over that 31-year period. However, because they sold whilst they were non-resident, the exact opposite happened. So they were fully taxable on the capital gain that accrued over that 31-year period. And as you can imagine, it was a property in Sydney, and you can get an idea of the sort of numbers that we're talking about here. So super, super critical point is to just be mindful of that. And, if you don't have to sell whilst you're non-resident and you're planning on moving back to Australia at some point and planning on moving back into that property, then, the best thing you can do is do nothing. Continue to rent it out whilst you're overseas if that's of interest. But yeah, one point to really flag and draw out that you want to try and avoid those very significant adverse tax consequences.
Yeah, and there can be benefits in holding off on selling that main residence if you're coming back to Australia. Because what's interesting with the main residence exemption is it's available to you again once you return to Australia. So that's by virtue of a rule called the temporary absence rule, or the 6-year rule, it's also known as, which essentially allows an Australian expat to rent out their former main residence for a period of up to 6 years. And if I use a really basic scenario, if that Australian expat returns to Australia in year 6 and then disposes that property as a resident for tax purposes, so they've resumed their Australian tax residency status, that's what's really critical, they may still be afforded a full main residence exemption on the sale of that property. So there are some strategy opportunities there where if you plan ahead, you can still be afforded the main residence exemption. There's many different scenarios that can play out with the main residence exemption, so we won't go through many different scenarios, but just understanding that there are still opportunities for Australian expats to still use the main residence exemption if they're planning on coming back to Australia. We'll touch on the second, I guess, capital gains concession, which is the 50% CGT discount. Nathan, do you just want to give a bit of a summary in terms of how that works for Australian expats?
Yeah, so I'll start with, as an Australian tax resident, how it works. So if you own an asset, could be property shares, for more than 12 months, and then sell that, then you get to effectively cut the capital gain in half and only pay tax on half of the capital gain. Now, unfortunately, when you're a non-resident, that exemption goes away. So if you owned the particular asset for a mixed period, i.e. you were non-resident for some of the time and resident for some of the other time, then you'll get a pro rata capital gains tax exemption. But if you were non-resident for the whole time, and we're talking specifically about Australian property here, if you're non-resident for the whole time, then unfortunately there'll be no 50% capital gains tax discount available. So if you do sell whilst non-resident, then you'll be subject to full Australian tax at up to 45% tax rate.
And the rules around the 50% CGT discount can get even more complicated if you held that property before the 8th of May 2012, because that's when we had that change in the rules for non-residents for tax purposes, where prior to the 8th of May 2012, you were afforded a 50% discount on the capital gain in the value of your property as a non-resident. So again, there's another calculation that needs to be worked out when determining what the capital gain is. Sometimes you get a market valuation on the property on the 8th of May. So it can get quite complicated when an accountant or a tax advisor is looking at the timeline for when you've held this property and working out your capital gain on the sale of that property.
The other point, just to add to that, if you're selling an Australian property as a non-resident, there is a withholding tax requirement. So upon settlement, 15% of the sale proceeds go across or get paid across to the ATO. So, depending on your particular situation, if the actual tax that you owe is a lot less than 15% of the sales price, then you can actually apply to the ATO for what's called a variation certificate, so that on settlement, the correct amount of tax is withheld and paid across to the ATO. So be mindful of that. I've had a few people that didn't know about that, and they realised why they didn't have enough money to repay their mortgage on settlement, because 15% of the sale proceeds had to get paid to the ATO. So yeah, be very mindful of that if selling an Australian property whilst non-resident.
Yeah, it can create a real cash flow crunch, right? Like if you're planning on paying down the mortgage, you're going to allocate. There were funds earmarked from the proceeds of the sale for that mortgage, and it turns out that 15% of the sale proceeds is being withheld. That can create some complications for you in managing your cash position and your financial affairs. We touched on capital gains on property. Why don't we touch on capital gains on shares for Australian expats? So do you want to, because they're contrasted, we can contrast the two asset types. And for a non-resident, for tax purposes, the tax treatment of shares is a little bit different. I think if you were the correct terms to, I guess, categorize these two types of assets, you've got taxable Australian property, TAP, which is essentially physical assets in Australia, such as your real estate assets, commercial assets, land and the like. These are considered taxable Australian property as far as the ATO is concerned. And then you've got non-taxable Australian property. So these are your more digital assets, such as your shares, ETF managed funds and the like. Do you want to just summarize how those two assets are taxed differently from a capital gains tax standpoint?
Absolutely. So as a non-resident, if you purchase a non-taxable Australian property asset, if you purchase and sell whilst non-resident, then guess what? There's actually no capital gains tax to pay in Australia, which is not a bad outcome. I guess just contrast that with a timeline. So let's say you purchase the asset whilst you're an Australian tax resident, and then at some point later on, whilst you still had the shares in this example, you had you became non-resident for Australian tax purposes. So there's an important point that happens there is there's what's called a deemed disposal of your non-taxable Australian property assets on the date that you became non-resident. So effectively you're treated as having sold those assets for their then market value. So if there was a capital gain accrued at that point, you'll pay some tax in Australia. If there was a capital loss accrued at that point, then you'll get to record the loss and carry that forward to use in future to offset future capital gains subject to Australian tax. So that, again, talking about sort of cash and liquidity positions, so that can cause a bit of an issue because you haven't actually sold the underlying shares, but yet you've got to pay some tax on that on the point that you become non-resident. So that's an important point to manage from a cash flow perspective. The other thing I would add to the deemed disposal is just circling back to our earlier conversation about double tax agreements. So this is another good example of where a double tax agreement can actually come to your rescue in terms of you can elect not to do the deemed disposal, but still be outside the Australian tax net when you actually sell those shares in the future, because you're protected by a double tax agreement, which may mean that the country that you're resident in only has rights to tax the capital gain on the sale of those shares. So that's that. And then if we fast forward to you're about to finish your period as being a non-resident and return to Australia and become resident again, then what happens with your non-taxable Australian property is that the actual price that you paid for those shares, assuming that you bought them whilst you're non-resident, that gets ignored, and effectively the cost base or the deemed purchase price of those shares becomes their market value on the date that you become Australian resident again. So, this can be a great opportunity to effectively minimize your tax in your host country and in Australia if, for example, you were to sell those shares shortly after arriving back in Australia. So plenty of opportunities from a tax planning perspective with non-taxable Australian property such as shares.
Yeah, it really speaks to the wealth accumulation strategies that you can employ as an Australian expat and the advantages that you have as a non-resident for tax purposes. So the ability to invest in shares, ETFs, managed funds, those assets increase in value. That increase in value falls outside of the tax net of the ATO. And if you're in quite a tax-friendly environment overseas, depending on where you're based, somewhere like Singapore, Hong Kong, where there is no capital gains tax, these types of investments can really be a powerful tool to grow your wealth during your expat journey. And I'm really glad you brought up deemed disposal before, because that's something that I often see get missed with a lot of prospects and clients that I speak to. So it's an opportunity for Australian expats. If you do have shares before moving abroad, there's a decision that can be made there, and that decision can save you substantially in capital gains tax down the track if you make the right decision in that first tax return in which you become a non-resident for tax purposes. So I think we'll round it out there, the discussion on shares. Just some final questions in terms of just understanding maybe some of the common mistakes that you see Australian expats make when filing their tax return. What would you say are the top two?
So the point that you just mentioned about the lack of the deemed disposal when moving from being a resident to non-resident is a common one that's missed. And even to double down on that a little bit further, understanding the interaction of that with the double tax agreement between Australia and the country that you're now residing in and tax resident of is a super important point to mention and to focus on. I think that the second one is, even if you remain Australian tax resident under Australian domestic tax law, if you are living permanently overseas and you are a tax resident in that overseas country, it is highly likely that you will be treated as sole tax resident of that country for the purposes of the double tax agreement, which means things like local employment income don't need to be taxable in Australia, even though you are still an Australian resident under Australia's domestic tax law. So that's a really common one that I see, that expats end up paying tax in Australia on their foreign employment income when they don't need to. And it obviously combine that with where expats have a HECS or help debt and having to make a minimum repayment against that on an annual basis, that can really cause a liquidity crunch and, in a lot of cases, unnecessarily cause a liquidity crunch that could have been avoided.
Absolutely. And I think the overlaying message there is get some tax advice, particularly in that first tax return. If when you become an Australian expat, is really crucial, because it's just going to save you tax in the long run, and it's going to give you that clarity around how you should be managing your tax affairs moving forward. So yeah, thank you, Nathan, for coming on the episode today. It's been super informative. I'm sure our listeners have really learnt a lot from your insights today. So yeah, encourage anyone that's looking to understand their tax residency status, looking for some guidance on their tax affairs. Someone like Nathan at Costical Tax is a specialist when working with Australian expats, and I understand you do a lot of work with clients, specifically in the UK as well.
For those Aussie expats that are based in the UK and or any British nationals that are emigrating to Australia, then with my fellow directors, Brad Murphy and Darren Catherall, we can provide specific integrated UK and Australian tax advice, tax planning advice. So this is very much about how to optimise your tax affairs going forward. So feel free to reach out to us at ukautax.com, and we'd be more than happy to help.
Excellent, mate. And we'll see you guys in the next episode. Cheers.
Cheers.
Thanks for tuning in to today's episode. If you want to learn more about Runway Wealth Management and how we help Australian expats, feel free to jump onto our website, runwaywealth.com, and we're also on all the social media platforms.